Hi, Joaquin. How are you?
Hey, Chris, how's it going?
Good, thank you. It's been a little while since we've done this. I thought
Yeah,
it'd be a good time to touch base. So much has happened since the beginning of the year. Obviously, there's so many assets that have done well over the last little while, both in the U.S. and outside of the U.S. We're going to focus on a few assets today that I'd like to talk to you about. I'm going to start. Why don't we just get right into it? I'm going to start with a little chart here, which comes from a famous Christmas movie called Rudolph the Red-Nosed Reindeer. I think everyone knows that. And this is Yukon Cornelius, who loves gold. So why don't we start with gold?
yeah,
This has been so at the end of the day, what's happening now, every day we come into the office, we see that gold prices have, new highs, new highs, new highs. I think a lot of people are jumping in now because of kind of this whole U.S. deficit story, debasement. Is this, there's some merit to this, but is this the only story supporting gold? That's the first question. And secondly, what do we think about gold? Do we see that this kind of run can continue?
yeah. So, look, it's definitely been one of the biggest stories of the year. We even see it in terms of client interaction. I would say, like in the last month and a half in particular, a large share of the questions we've been getting are related to this. And I do agree with you that it's sort of starting to spark broader interest. I think sort of to set the stage on that, actually, I think an important stat to keep in mind is that with maybe a few exceptions, gold is historically accounts for a very small share of institutional portfolios, right? So if you look at surveys of assets under management across pension funds, endowments, hedge funds, family offices, whatever, rarely does it actually exceed 2 or 3% of holdings. And so in a context where it's true, like if you go back to just look at raw performance in the last 2 years in particular, there is an enormous difference between portfolios that hedged equity risk with gold versus those that hedged equity risk with bonds, right? I was looking at this morning. If you adjust for inflation, the real return you've gotten on G7 sovereign debt since 2022, since the start of central bank hiking, is minus 24%. Over that same period, you would have doubled your money when investing in gold, even when you adjust for inflation, right? And so it does make sense, I think, for people to be looking at it further. What I think is, look, it's the second year that we've gotten strong returns in gold that coincide with strong equity returns, which is a bit of a strange pattern, right? Because usually you would expect one to do well when the other asset isn't doing particularly well. This hasn't been the case in the last couple of years. I would say that last year's rally was partly fueled by speculative purchases, not only in the West, but also in China. There was a lot of retail demand in China for gold as an alternative store of value. This year, the rally has broadened a lot. And what we think is really interesting is that it's happened in a context in which net long positioning by money managers, which is essentially a proxy of speculation, in COMEX, which is the largest gold exchange in the world, in the US, those have declined relative to 2024, right? So there's less speculative buying, although it has picked up in the last month. And yet you see gold breaking past $4,000 an ounce. It's by one of the best performing asset classes this year. So I think sort of a good starting point is like, okay, what's driving this, right? I think there are two or three important things to consider, some that are very important for the longer term outlook. The first one is central bank buying. Everyone talks about this. What I think is important here is that if you look at official statistics of gold reserves by central banks, so central banks are actually the only investor type, if you will, that holds a large share of their assets in gold. So it's about 20% of the reserves are in gold, which is about double than what it used to be 10 years ago. But even that number we find is underestimated probably by the actual number of reserves they hold. So because of geopolitical tensions after the Russia-Ukraine war, some emerging market central banks, particularly the PBOC, they've underreported the amount of gold that they hold relative to the amount of gold that's actually physically entering China in particular. What we find is that since 2022 onwards, the amount of gold reserves that the PBOC likely holds is at least 30% higher than what they actually report. And so this is a very steady pattern. It's a persistent pattern, and one that will continue to provide support because central banks are one of the largest buyers of gold, so they account for a large share of demand. The other component has to do with private sector demand, which is institutional investors and retail investors. Now, beyond speculation, the standard way in which you position in gold is through these sort of physically backed ETFs. GLD is the biggest one, but there's a whole bunch of them. What's interesting is that if you have positions in that, like if you buy that ETF, those ETFs are physically backed by gold, and so you're actually adding to gold demand if you do that, right? And in the last 6 months in particular, you do see an uptick in demand for ETF demand when that had actually been quite weak since 2022, because it's that component of demand is very interest sensitive, right? So as interest rates rose, the perceived opportunity cost of holding gold was higher, and so professional investors didn't really want to hold it. Now the Fed has restarted the easing cycle. There's expectations of further Fed cuts. The job market is slowing down, and that has sparked demand for gold. There's also this whole idea you were mentioning before around sort of the debasement trade and, bonds aren't really working out, and that probably amplifies that rotation towards gold. So those two things, I think, will remain a source of support in the next 12 months at least. In that environment, we still find a high probability that gold will continue rallying from here. What we find is that the fair value of gold is actually quite high. I don't know if it's quite 4,000, but it's definitely 3,800, 3,900 for sure. And so that provides support. The one caveat in terms of the raw upside for it is that there's a portion of the movement we've seen this year which is related to hedging macro risks in a context of high policy uncertainty. COMEX themselves bought a whole bunch of gold ahead of Liberation Day because they were worried that gold from Switzerland was going to get duties. And you're going to lose that basically as a source of support in 2026, right? And so what we find is that the sort of pure alpha potential of gold is lower than what it is this year. And we can talk about this further if you want, but as a diversifier of portfolio risk, it remains still very, very appealing, very attractive. And so from a global asset allocation standpoint, we published our latest report on that this morning. We remain overweight in gold, even if we no longer have a pure long position on it.
And so what about looking at another precious metal that maybe has not rallied as much in our opinion, which is silver? Is that something that, there's maybe more potential upside?
Yeah, so unlike gold, we do have a pure long position open on silver. We started pushing our views on silver early this year.
I'm just going to stop you 1 second, but just to clarify, from a global asset allocation perspective within the portfolio, gold, we still have it as an overweight, right? So substantially, I think I checked this morning, I think we're double the standard weighting.
Yeah, in fact, what we do in the optimization framework is we set a cap on any asset to doubling the benchmark weight. And so it's basically hitting that ceiling.
Okay, perfect. All right.
So we're definitely overweight. It's just that as a high conviction trade, we like silver more than we do gold. We think it has far more room to rally. A very simple thing to look at is if you adjust for inflation, the price of gold today is at an all-time high. If you do the same exercise for silver in 1979, there was an episode in the late 70s for those sort of interested in precious metals. There was the Hunt family tried to corner the silver market in the late 70s. What that did is it drove up the price of silver to what today would be $150 an ounce. The price of silver today trades at 50, a little over 50. So that there's still quite a bit of room to go in terms of sort of hitting its historical high. But what I'd say sort of makes us optimistic around silver is obviously you don't have the central bank element, but you have three very important structural stories. One is on the supply side. So the supply for gold doesn't really matter, right? Because gold doesn't deplete. We have basically, you can probably trace back gold to the beginning of time, pretty much, right? That's still available. In the case of silver, mining does matter. It can affect the balance. But what's interesting is that there's a very small share of silver production that is by dedicated silver mines. The majority of them is a byproduct of mining of other industrial metals, like copper, for instance. Like Codelco, for instance, in Chile, the biggest copper miner, they're like the 5th largest silver miner in the world or something like that. And what's happened is that since COVID, there's been a significant decline in sort of capex in mining. And so that's holding back supply growth, and recycling just can't compensate for that. It's actually very difficult to recycle silver, and so you just can't compensate for it. So that provides a floor. But then on the demand side, it plays on 2 themes that we think are very important as long-run themes. One is the AI story. So silver is it's not only a precious metal, it's also an industrial metal. It's used very extensively in electronics. It doesn't use that much in semiconductors, say relative to copper, but in general, if demand for technology continues to rise and that drives up interest in tech and electronics, then silver is a bit of an indirect play into that, and so that's going to drive flows probably into the space. And then the second one is gold is a transition metal. Silver is more conductive than gold and copper. And it's used very extensively in green energy applications, like PV solar panels, for example, use a lot of silver. And that's growing at an extremely rapid rate in China primarily, as China, adopts more renewable energy. In that kind of environment, the rate of growth that you have in physical demand for silver far exceeds the pace of supply growth. And so you have that backdrop, which makes it a very appealing structural play, not only because it's a precious metals and it kind of depends on the same dynamics we were talking about for gold, but in addition, you have this further layer of market tightness that makes us very confident that the rally will continue.
Good. Okay, so let's move on to, I'd like to talk about 3 different sectors. Yep. The first is going to be tech, second one's communication services, and the third is utilities. Let's start with tech. I'm going to show you a chart here. This is since 2019. We've had massive outperformance from tech stocks relative to all the other sectors, all the 10 other sectors in the US. I'm going to pull up another chart, so keep that in mind. And so I guess the question is, are we in a bubble? What if we're not, what stage are we in, or where do you think we're at? And so I guess the most important question for investors is, can tech stocks continue to do well, continue to outperform, or at least continue to have positive returns? Obviously, this is the whole AI story, and I think you've got to obviously talk about or start with that.
Yeah, of course. So look, if you on that second chart you showed, we still think you're in that second stage, in the boom stage. We're not in euphoria mode. There's been a lot of comparison, increasingly with the .com experience. We find that the current environment is very different from the .com era. The key difference is that during the late 90s, the pace of growth that you had in demand for technology simply did not justify the valuation levels that you had in the market. So we use these modeling techniques to estimate fair value for different asset classes. In the late 90s, what we find is that given underlying macro fundamentals and market-specific fundamentals like demand for technology, like long-term rates, like the degree of market concentration, and so on, tech stocks were trading 30% over fair value, at least 30-40%. Today, what we find is very different, where the rally has been accompanied by exceptionally strong growth in demand for technology, which in fact is not only driving tech alone, but it's actually doing heavy lifting for the economy overall, which is very unique, right? So what we're seeing in the first half of the year, you had real capital spending, so CapEx, on hardware and software, very much driven by the AI boom and growing adoption, of 25% annualized. Now, this is a segment that makes up 5% roughly of GDP. And so if you're growing at 20% or more, you're adding 1 point to GDP, which is huge, right? Huge. So the trend rate of growth is 2.5, let's say. So you're adding an additional percent to that. So ultimately, the question to us is less so, are we in an equity bubble? By equity bubble, what we mean is a situation where the share price of a sector or a stock is completely detached from fundamentals. We don't find evidence of that. What the risk is to us is that we may be at the start of an AI spending bubble, whereby there's too much growth in infrastructure investment for the future level of demand you're going to get in AI. So, for example, like adoption rates, they're growing, but they're not super high outside of white collar industries. So if you look at IT, for instance, the adoption rate of AI is already more than 20%, meaning that 20-25% of companies use it on a regular basis for production. In other parts of the economy, it's sub 10%, 5% or less for blue collar applications. And so the question then becomes, how easy is it to monetize this, be it through productivity gains or through actually revenue generation? If you can't find a strong case for that, and sort of, I guess the jury's still out, then it may be that you end up actually overbuilding relative to the future level of demand. The other question, and I guess that brings us to communication services, is what happens if demand remains strong, but there's enormous efficiency gains in like ML inference, such that you need less infrastructure to obtain the same results. And that's kind of what happened with DeepSeek earlier this year, right? Because if you get a DeepSeek type world where you can basically run these frameworks at a fraction of the cost, then why do you need all of this infrastructure for semiconductors, for data centers, and so on, right? If you're in online media, if you're in communication services, you actually would benefit from these productivity gains, right? Because ultimately what you're looking for is gaining productivity and, say, doing more targeted ad spending. But if you're a pure IT player, if you rely on direct revenue exposure through hardware, through semiconductors and so on, that I think is sort of the key risk. And so I think the key distinction today is we don't think you're in an equity bubble, but there might be a risk of a spending bubble. For now, the pace of growth is so strong that we're still certainly overweight in technology, not just in our US asset allocation coverage and our sector rotation coverage, but we've actually upgraded the US to a pure overweight in our global asset allocation coverage. Because typically when you get these sort of strong growth and demand, it's something that lasts for a while. So obviously we don't know for sure, but if you go back to the late 90s experience with the ICT revolution, you had 20 consecutive quarters in which investment in IT hardware and software, which at the time made up a very small share of GDP, grew more than 20%, right? Now we're like 2 quarters in, 3 quarters in of that pace of growth. So it's probably still early innings. And I think, maybe you want to be smart in the way you position yourself and maybe hedge a little bit of the risk. But I think, for now, if you don't have tech exposure, you're definitely missing out on a lot of upside.
Right. I was reading recently that doctors back in 2023 had an adoption rate of AI of about 2%. And today it's gone to about 7%. So, I mean, does it mean everyone's going to, every different sector is going to adopt it? No, but I think from our perspective, there's still room for adoption here.
Yeah, and just one brief comment on that. I think for something like that, it's useful to track adoption of like disruptive technologies of the past, like say online penetration rates in e-commerce, how quickly, when did those plateau, internet adoption in the early 2000s, all of those things are sort of useful proxies, I guess, for the pace. And I still think we're early innings still. For the economy as a whole, you're sub 10% still in terms of adoption.
So we've been long tech for a long time now. We've been long communication services, online stocks in particular, which have done exceptionally well. Another sector that we've been long is utilities.
Yes.
And I think this is, I was reading today how now it's the flavor du jour, where, utilities, a great area to invest in without taking the risk of a tech company to play the AI story. So can you elaborate on our long and why, if we remain long on utilities?
Yeah, look, we've been overweight utilities for more than a year now. Yeah. We actually put out a high conviction piece a little over a year ago saying that you should go long utilities. That trade worked out really well. Since then, utilities has gained close to 20%, I think, in real terms. And pretty much every argument that we laid out at that time worked out. The only one that hasn't yet is sort of the interest rate differential, because utilities is a dividend play. We can talk about that in a second. But what really has happened, and at a faster speed than we actually expected when we first wrote about this last year, is that demand for power in the US is growing at a far faster rate than it has in the last 20 years. So in the first half of the year of power demand, so demand for purchased electricity has grown about 4.5% annualized. That's far stronger than GDP growth. And it's way, way stronger than what you saw in the last 2 decades, when actually power demand sort of trailed consistently GDP growth through efficiency gains, adoption of renewables, so on, and offshoring, right? Because the manufacturing sector is a huge consumer of electricity, and production has done nothing in the U.S. until at least recently. What I think is interesting, it's a bit difficult to pinpoint this with true precision, but what we estimate is that data center usage falls under the commercial category for power generation. So the three big categories would be residential, commercial, and industrial. Commercial accounts for about 40% of the rate of growth we've seen so far in utilities this year. We estimate that about half of that growth, so 20 to 25% of the overall increase, is coming from data centers alone, which today we estimate account for about 4% roughly of overall power generation. If you go with the forecast that the International Energy Agency and other sort of experts are going with, this thing is going to keep rising at a very rapid rate. They're expecting, trend growth of 20% over the next 5 years at least. And that's in all sorts of data centers, not just hyperscalers, but also, rentals and, proprietary data centers by non-tech companies, anything like that. The expectation is that it's going to grow at a rapid rate. As long as that continues and the AI spending boom continues, that will certainly improve the margins of utility providers, not only in terms of demand, but also because it makes it easier for them to try and pass on higher base rates, which is basically the profit that they make on their investment. So they're going to have to invest more, right, to meet that demand. And they're going to likely lobby and push for higher base rates, which is already the case in the last couple of years. The reshoring story is another important source of support. I think that one is it's less talked about, but I think it's very important, simply because it's about 25% of demand for power, right? And so if you have an acceleration in production and heavy industry in the US through, support through a CHIPS Act, defense spending, substitution through tariffs, anything like that, that would be beneficial towards utilities. And then the final point that I would mention is that the typical interest or flows into the utility space are influenced certainly by the rate differential that exists between long-term interest rates and the dividend yield you get on utilities. Right now, that gap is enormous still, right, where you are better off just parking your money in T-bills, essentially, than buying utilities as an income play. But as the Fed continues to cut interest rates, which we expect that will continue, then that gap will very likely narrow. And if it narrows, that will further add liquidity into the space beyond the AI story and so on. And so in that kind of environment, I think it does make for an attractive portfolio diversifier. we're long utilities or overweight. It's our favorite defensive category because it's not just a defensive in the sense that, oh, if the unemployment rate rises, then you want to own some defensives. It has sort of these structural tailwinds that, benefit it further, which essentially healthcare and staples don't have, right?
Right. And staples are very expensive right now.
Absolutely.
And so I think anyone looking for interesting value in a defensive utilities is an area to look at. So thank you very much for this. Maybe at the beginning or mid-December, we can do this again. We usually come out, or we will be coming out with our 2026 outlook in December. And once we publish that, maybe the day after, we can reconvene and talk about our views and our best ideas for 2026.
Sounds good.
All right. Thank you so much, Joaquin.
Take care, Chris.
Bye-bye.